In this video, I'm going to be talking specifically about US government bonds and how you can invest in them. And at the end of the video, I'm going to share with you what I'm doing personally and whether or not I'm going to invest in US government bonds. So stay tuned for that. Before everything else, let's take a moment to talk about what a government bond is. A government bond is a loan to the government. When you buy a government bond, you are loaning your money to the government in return for a fixed rate of interest, also known as the coupon rate. US government bonds are considered to be a very safe investment. That is so because the US has a growing advanced economy. Thus, the US government is guaranteed to be able to collect enough tax revenue from its citizens and corporations to repay its debt. Even in the case that the US government is not able to generate enough tax revenue, investors have high hopes that the US government will just print the money to repay the debt. Now, let's take a look at an example. If you invest $1,000 in a 5-year government bond with a 2% annual coupon, you will be paid $20 every year for 5 years. And when the bond expires after 5 years, you will get your original $1,000 back. There are pros and cons to investing in US government bonds. The pros are US government bonds provide guaranteed return. Since the US economy is very unlikely to fail in a major way anytime soon. Also, they are highly liquid. Essentially, you can buy or sell a government bond at any time when the market is open. Additionally, they are exempt from state and local taxes. The cons are US government bonds are not much better than online savings accounts and CDs in terms of the interest that you will get. Also, they offer low yield, thus you will only keep up with inflation at best in most cases. The common types of US Treasury bonds based on maturity dates are Treasury bills, T-bills. These are short-term securities of 1 year or less. Treasury notes. These are medium-term securities of 2 to 10 years. Treasury bonds. These are long-term securities of more than 10 years. TIPS, notes or bonds. These are medium or long-term Treasury inflation-protected securities. With TIPS, the price of the bond adjusts on a yearly basis based on inflation. That way, the money you invest in TIPS does not lose value to inflation. And the last common type is FRN, medium-term floating rate notes. The interest rate for FRNs fluctuates based on a benchmark like the Fed funds rate or some other benchmark. FRNs are more like variable rate mortgages. Government bonds are inversely related to interest rates, so if interest rates go up, the bond value will go down and vice versa. The best time to buy bonds is when the economy is in expansion and interest rates are high. That way, when the economy slows down or goes into a recession and interest rates go down, the price of your bonds go up. Typically, bonds with longer maturities pay a bit higher yield. However, the longer the term, the riskier the bond is. That is because we do not know where interest rates or inflation rates are going to be in the future. Now let's talk about ways to invest in US government bonds. The first way to invest in government bonds is to buy them directly from the government through the website treasurydirect.gov. Once you are on the site, you can create an account and link your bank account to it, and after that you will be able to buy US government bonds directly from the government without having to pay any additional fees. You can also buy government bonds through a brokerage account like Fidelity, Charles Schwab, or E-Trade, but you will pay a fee every time you do that. So I recommend using treasurydirect.gov instead. The second way to invest in US government bonds is to buy a bond ETF. There are many bond ETFs for all types of US government bonds. Bond ETFs are good for people who are trying to build a diversified investment portfolio or hedge against the risk of investing in stocks or just speculate on interest rates. As I mentioned before, when the economy enters a recession, stocks usually go down, but bonds tend to go up in price due to the central bank lowering interest rates to stimulate the economy. Some examples of bond ETFs are SHV, which holds bonds that mature in less than 1 year. The fund currently pays out a dividend of 1.55%. SHY, which holds bonds that mature in 1 to 3 years. The fund currently pays out a dividend of 1.85%. IEI, which holds bonds that mature in 3 to 7 years. The fund currently pays out a dividend of 1.74%. IEF, which holds bonds that mature in 7 to 10 years. The fund currently pays out a dividend of 1.65%. TLT, which holds bonds that mature in 20 plus years. The fund currently pays out a dividend of 1.66%. When looking closely at the price chart of these ETFs, you can see the effect of interest rates on the price of these funds. As you might know, interest rates have been going down for the past 9 months or so. As a result, all these bond ETFs have gone up in the same period, with TLT having gone up the most. Now, would I invest in US government bonds at the current time? The answer to that is no, mainly because the yield on government bonds currently is low. Additionally, interest rates are at all-time lows and bonds are at all-time highs. So it's very likely that the next move in interest rates is going to be up, which is going to negatively impact the price of all bonds, especially long-term bonds. Personally, I prefer online savings accounts to get some yield on my savings. If I really had to put some money in US government bonds for some reason, then I would stick to T-bills and I would buy them directly from treasurydirect.gov. If you liked this video, make sure to hit the like button and subscribe to my YouTube channel. And now, I want to turn it over to you. Would you invest in US government bonds? Why or why not? Let me know by leaving a comment below. Thanks for watching.